The US jobs report yesterday surprised on the upside with 130,000 new non-farm job additions in January, unemployment ticking lower and wages steady. Markets immediately scaled back the Fed cut expectations on the back of the data, but the headline numbers mask some weakness there and won't change the fact that 2025 was one of the weakest years for US jobs market outside a recession. So the verdict is not definitive just yet. Investors now look to Friday's CPI release from the US for clues on what the Federal Reserve should do next, while AI fears continue to ripple through sectors, real estate stocks being the latest victims. So welcome to Swissquote's Daily Market Talk. It's Thursday, February 12th. I'm İpek Özkardeşkaya, and everything I will say in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
The US jobs data release yesterday was too strong to cheer for investors because the report printed 130,000 new non-farm job additions last month in the US, and that was double the market expectations. The unemployment rate, on the other hand, ticked lower, and the average hourly earnings came in higher than expected by analysts as well, at a steady 3.7%, as the earlier month's data was revised slightly down to this level. Now, the data immediately hammered the Fed cut expectations because it was stronger, way stronger than expected, suggesting that such strong job additions in the US could buy time for the Federal Reserve before it lowers rates again. So in the aftermath of the US jobs data, activity on Fed funds futures now assesses no more than 21% chance for an April rate cut and less than 60% chance for a June cut. In the market, the US 2-year yield that captures the Fed rate bets rebounded to 3.55% yesterday and is now consolidating near the 3.5% level this morning. The US dollar recovered its early weakness but couldn't reverse early week losses either, while the US equity markets fell on waning Federal Reserve rate cut dreams, and Bitcoin also extended losses below the $70,000 psychological mark. All in all, yesterday's good news from the jobs report was clearly interpreted as being bad news by investors. A classic. But the story doesn't end here. If you dig a little more, most job gains came from healthcare, social assistance, and construction sectors last month in the US. Other sectors like federal government and financials, for example, reported job losses. And this uneven jobs growth may not lead to an improvement in the longer run, it is said. And two, and more importantly, there is Bloomberg journalist warning this morning that the BLS seasonal tweaks and modeling could actually be overstated the actual underlying jobs growth in the US, and that the true growth may rather be around 40 to 50,000 job additions and not 130,000. And if you zoom further out and take the panoramic view on the US jobs market, well, the US labor market was far weaker than the monthly headlines suggested last year. After the BLS benchmark revision, the US economy added roughly 181,000 jobs in total during the entire 2025. That's about 15,000 jobs per month on average only. One of the weakest annual job additions outside recession years since the early 2000s, probably a reflection of the White House's immigration policies. So the knee-jerk reaction to yesterday's data may have been decisively hawkish, but the headline numbers clearly hit a bit of dirt underneath. So that's probably why we saw the US yields and the US dollar both return toward the pre-data release levels yesterday, and investors are now waiting for the next important release, the US CPI update that is due Friday. That data is expected to print a 2.5% rise in US consumer prices, a weak number compared to the past few years, and an easing trend that could revive the Fed dose again and give a bit of hope to those who were banking on a few Fed cuts this year to further fuel the US stock rally. So before jumping to final conclusions for this week, let's see how the CPI update looks like and how it is calculated, of course, because you would agree with me that since the BLS chief got fired last year over a set of weak jobs data in the US, well, there are now a lot of questions and worries regarding the practices, the statistical practices that lead to the US economic data. The funny thing about all this is that the White House took credit for the strong jobs figures of January yesterday, but they're also pushing for rate cuts from the Fed. And the two are not compatible. You cannot have a smoking hot labor market and low interest rates and low inflation as well. There should be a balance, and today that balance is again tilting toward a longer wait before the Fed's next rate action, and that may not please the White House. What do you do? In the equity space, the major US indices, both small, medium, and big cap indices, were marginally down yesterday after the sight of that unexpectedly strong jobs figures. The sell-off in global software stocks continued on the other hand, with St. James Place losing more than 13% in London yesterday, and Dassault Systems tanking more than 20% in Paris after weak results. In the US, iShares software ETF fell another 2.5%, and the real estate stocks now joined the AI panic room. But funny enough, there wasn't one major headline that led to this dramatic fall that we saw yesterday across real estate stocks. It was just a handful of analysts out there warning that AI will have a negative impact on jobs, and that could eventually weigh on commercial real estate demand. Now, my take is that this AI anxiety is getting out of control, and the sell-off that results from it will bring interesting opportunities for investors who would like to take a positive stance on AI. The world will not collapse by tomorrow, and we will not be all replaced by robots, and if it's the case, who cares about businesses and returns anyway? Robots will have to care about it. So keep calm, take a deep breath, and look out for opportunities. In the FX space, the dollar yen was up for the fourth consecutive trading session this morning in Japan, but the Japanese yen bulls are now losing strength into the 152 Fibonacci support, which would be calling the end of the Japanese yen's medium-term weakness against the US dollar. So that would be a meaningful reversal in dollar yen trend and a strong relief for Sanae Takaichi, because one of the biggest worries in Japan right now is the rapid depreciation of the Japanese yen, which also boosts imported inflation and demands a careful monetary policy approach from the Bank of Japan as well. But if the yen selling is over, a part of that pressure would be also over, and that would be good news. Now, the Nikkei is down this morning following US peers lower. Normally, historically speaking, the Nikkei has a negative correlation with the Japanese yen, but that negative correlation may weaken in the coming months if the yen's strength leads to a more patient and more accommodative Bank of Japan policy and longer and softer policy normalization path. Elsewhere, US crude is doing great since the start of this year. The barrel of US crude is now flirting with the levels above the $65 per barrel level and is building a support above a key Fibonacci level, which is the major 38.2% Fibonacci retracement on a decline during the second half of last year, and that stands near the $64 per barrel mark. The question is whether the past few weeks' rebound in oil prices could lead to a sustainable bullish trend in the coming months. The soft US dollar is supportive, the ample global supply is challenging, and geopolitical headlines could be noisy. A part of the latest bullish push in oil prices was explained by the tense relations between the US and Iran. So what will be decisive in the short run is what happens when the latter tensions will ease, right? Holding support above the critical $64 per barrel level, in my opinion, should keep the US crude in the positive consolidation zone and encourage further gains, but a return below this level will probably throw the market back to the bearish price narrative and encourage a return toward the $60 per barrel level. The good news is that the energy sector is surfing on good news and the price action these days, and may also hold on to their gains in the context of rotation trade if oil prices were to lose altitude in the coming weeks. So it's a good place still, and it is an interesting place to be for investors who are looking to avoid the technology earthquakes. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us and let YouTube know that you enjoy these videos. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.